Hi there, folks. Thanks for joining us today as we're going to not only talk about disability insurance, but specifically how to take a different look at disability insurance and essentially set up what we like to call a no-loss disability insurance policy. My name is Brock Falconer, Western Region DI Manager at Illinois Mutual, and in conjunction with OCI, we're bringing this broadcast to you today, and I really appreciate your time. Let's get started. Again, weighing the loss, a new way to look at individual disability insurance. At the end of the day, we know the odds. 1 out of 4 individuals will suffer a long-term disabling event during their working career. Let's not get hung up on the term long-term event, though, because really what we're saying is they will suffer at least a 90 consecutive day period of time that their paycheck stops. While that might seem minuscule, I think we can personally look at our own lives and think even a mere 90 days without a paycheck is going to cause us to dip into many things, including savings, retirement, potentially even maybe look at some assets if it's going to be a longer period of time. But let's find a way to avoid having to self-insure that situation, as that's really the role that disability insurance or income protection can play for us. We oftentimes like to talk about the idea of setting up a job B instead of a job A. Job A is our current position where we have a monthly income. We have a amount of money that we receive from our jobs as a paycheck. However, we know that the majority of us, if sick, ill, or injured and not able to work, would receive $0. What if we could change that job A and make it into a job B? That means we have a small percentage off the top of our income. However, sick, ill, or injured, we still have some tax-free money coming to us on a monthly basis. Our clients that self-insure their disability in event is essentially any client that's in a job A position. Fantastic price for the policy, of course, because you're paying $0. You're on the self-insurance plan. However, maybe it makes sense to set aside a small percentage of your income, a penny to 2 pennies off every dollar, to make sure, again, should the initial paycheck stop, we do have a fallback payroll available to us. Job B is the same job A, but you have taken the responsibility of putting an income protection plan in force. At the end of the day, when we're looking at a new job opportunity and we're presented with the job A and the job B, I would hope that we find job B to be a little more comprehensive as a whole, because we're protected with a paycheck when we work, and we're protected with some cash-free dollars when we don't. Now, taking a separate kind of approach to that same job A, job B experience, I've set up kind of a reimbursement concept that I like to call baby math. The numbers need to be simple for me to understand them, and I think it's a fantastic way to really describe what income protection, paycheck insurance, disability insurance really is to our clients and the tangibility of it. A client's income is $50,000. The maximum benefit based off of that income, and really based off of any income, is going to be right around 60%, which seems low, but keep in mind that's a tax-free benefit. In this case, that would work out to be about $2,500 a month, tax-free. Keep in mind, if the income's much higher, maybe the benefit amount is a smaller percentage of replacement, but based on them being in a higher tax bracket, that client still is going to have about 80 or 90% of their take-home pay covered, which is really what that $2,500 a month tax-free amount means to this client making $50,000. As a good rule of thumb for premiums for income protection, around 1% is definitely kind of a safe number. As we know, not everyone wears the same size shoes, pants, or shirts, but again, as a nice foundational approach to really what we're talking about here, 1% of income, especially in Illinois Mutual's Middle America environment, is a very safe and consistent number. In this case, that would be a $500 annual premium for this policy. Therefore, we know over a 10-year span, that client would have paid in $5,000 in premium for their paycheck insurance or income protection for that job B. However, we can see here that when on claim, because of some rudimentary math skills we're putting in place, a mere 2 months of being out and collecting that tax-free $2,500, you would have reimbursed yourself for that entire 10 years worth of premiums at $2,500 a month for 2 months. Now, the average length of claim is going to be anywhere between 1 and 3 years. So in a very short period of time of suffering a disabling event and not being able to work and needing your paycheck replaced, we can show the tangibility of really where this kind of policy is priced at. And really, in lieu of wiping out savings, retirement, and assets, we're going to reimburse every penny we put into it over a mere short couple of months, even after paying in for 10 plus years. So this is essentially another way to show the Job B. However, Illinois Mutual is a little bit unique in the fact that we actually have a Job C option that we can kind of tack into the good, better, best scenario here, because we have a very unique rider called return of premium, which would return all of a client's premium as early as age 65, minus any benefits Illinois Mutual might have paid should they have suffered any disabling events over their working career and received a benefit. Now, again, we've returned over $115 million since 1972, and the idea being, as we know our clients, this kind of disabling event is never going to happen to them, and therefore this is a way to kind of not only ensure their income, but ensure that frame of mind that they don't think this event is going to occur. So again, we can change that Job B to an actual Job C. We look at this same client with the same baby math scenario here, same $50,000 income, same benefit amount. Now we're going to show a 2% of income price because we not only have the income protection, but we have the ability to get 100% of our premiums back at retirement minus any claim dollars paid to us. Now we know the premium then is going to be about $1,000 annually, 2% of that $50K income. The premium now over that 10-year span of time would be $10,000. However, now an outcome of a claim at 10 years and 1 day would reimburse us 100% after 4 months of being on claim. Again, the average claim is going to be between 1 and 3 years. So even with the added premium to put in this money back guarantee rider, even going on claim, now we're looking at about 4 months to reimburse everything we put into it. But we know the odds. We started with that. 1 out of 4 people would essentially trigger any of these disability insurance products, which means that our clients are always going to connotate to, it's not going to happen to me. And we know there's a 75% chance that they're actually correct. So that's why this policy creates a no loss scenario, because your money is always in play for you. You have paycheck insurance and paycheck replacement should you go out because of this benefit. However, you also have 100% reimbursement should you not go out. So for 1 out of 4 people that go on claim, best thing they ever could have put in force. Only way to truly be responsible for your income protection, since believe it or not, no one's lining up, including Social Security, to replace that paycheck outside of you taking responsibility for it yourself. And 3 out of 4 people would not go on claim, in which case they would get all of their money back at retirement age, and hopefully have slept better knowing that they're protected should something happen to them during the entirety of their working career, or at bare minimum, at least to age 67. Again, Job A is the self-insurance plan, where you are taking advantage of paying 0 premium. However, sick, ill, injured, not able to work, you receive $0. Job B is our 1% of income scenario here, where after a mere 2 months of being on claim, following 10 years of paying in, you would reimburse everything you put into it. Job C, arguably the most comprehensive option, because you have the income protection, which is your money in play for you, that you reimburse yourself for everything you put into the policy after a mere matter of a few months. However, never suffer a disabling event, all of your money back at retirement age. Here's an example from an excerpt of an illustration that really shows you, again, the tangible feel of what that return of premium rider does for you, as well as what that investment does for you. As we can see here, the price of the policy itself is a hair over $1,000 annually, as that's not going to change. The benefit amount cost is the benefit amount cost. However, that rider adds about 73%, so we're not technically doubling the cost here, nor do we often double the cost. However, that 2% versus 1% is a great generalization to make sure you've built in enough premium. However, we can see if not invested in this return of premium rider, for that client, that's factored based off of their age here, after 27 years to get all of that premium back, which essentially the thought being all of that investment back, they would have needed almost a 6% guaranteed rate of return should they have separately invested that money. Again, here's the way that you can grasp, feel, and understand what this rider does for you. Because I guarantee there's going to be no financial planner out there that's going to give you any kind of guarantee close to a 6% return, especially over a 27-year span. This is, of course, conceptual because no true interest is gained on the return of premium rider or this policy. But again, with the opportunity to get all of your premium back after this 27 years, or essentially up until age 67 from whenever you purchase the policy, this is a great way to just show what that added investment does for you. Of course, the true idea being you're investing in your ability to always make sure you at least have enough of a paycheck to pay for the major expenses in your life. Because again, there are no companies, organizations, or associations that are going to really give you the same sense of responsibility for making sure that that paycheck stays there and helps you pay for all the important expenses in your life. While we all, I'm sure, have fantastic jobs and our clients do as well, let's be honest, we are working for the ability to have access to that paycheck, and job security does not stop at how solid your company is or the role you have at your company. Possibly the biggest bit of job security is whether you're actually able to perform the duties that are required of you at that job to be able to receive that paycheck. And there truly is no way to ensure that job responsibility than a disability insurance policy, income protection, paycheck insurance, however you want to box it and put a bow on it. Let's think again about what we're really competing against in our market as well. We're competing against someone that's throwing out probably anywhere between $40, $100, maybe even $100+ on their cell phone bill, with all the bells and whistles, unlimited data, and we know how important and how that's such a large part of our lives. But potentially there's some options where we're not doing unlimited data, or maybe there's a few small corners we can cut in a cell phone bill that again allows us that 1 to 2 pennies off of every dollar to make sure that we're not only ensuring our paycheck, but also our ability to pay that cell phone bill. How about some coffee? Maybe we do some more home brewing instead of going to the local coffee stand, either before, after work, or maybe even at lunch. Maybe if we go every day, we can go every second or third day. Again, we're not asking for someone to completely rearrange their life to be able to pay for something as important as their income protection, but something tells me there might be a way to shave off a little bit of expenses that are more luxury versus necessity, because we can show that income protection is a necessity. Cable TV similarly, maybe at least bare minimum for the summer months when we're more active out and about, maybe hopefully watching less television. Maybe there's an opportunity to cut back on some of the pay movie channels and or many things that we pay for through our cable TV and just with entertainment overall. Again, in not only making sure our paycheck is insured, but again, the ability to even have this luxury of entertainment. Let's think about really the foundation of someone's ability to live the life that they do as well. Everything is aligned upon their income, and everything's kind of taken for granted that income, the foundational part, is going to be there for us. We think of a Jenga tower of blocks. I think whether we're financial pros, whether we're in property and casualty, or maybe we're selling life insurance, we're doing fantastic things to make sure that tower of blocks is not going to fall over. And we're doing the best things in our proprietary markets to help our clients. But have we ensured the ultimate foundation for that tower of blocks, which is always going to be someone's income and an ability to not only pay those premiums, but also to pay for the most important bills in a client's life, such as the mortgage, utilities, and groceries? I think that maybe that's going to be the most important thing, and then we can build from there. Because regardless of how we pulled out blocks at the top of that tower to make sure it doesn't fall, I'm pretty sure 10 out of 10 times it's going to fall if that income goes, which really is that bottom row of blocks. We know what our income pays for. We know we're buying the best property and casualty, life insurance, and investment options there is, but we're oftentimes a little bit backwards in trying to ensure someone that never becomes sick after they die. and we're trying to insure someone so that they have all of the most important assets uh, protected in their life, but maybe we've missed the boat on the fact that the most important asset is your ability to earn an income. What's the guarantee that that ability will continue as we go forward? When we think of a disabling event, oftentimes we connotate to a severe accident or injury, but keep in mind that the majority of disability insurance claims are due to illness. Keep in mind that when your paycheck stops due to an accident, injury, and even more specifically and more predominantly illness, not only do we have a lack of paycheck and a lack of ability to pay our normal everyday expenses, but our expenses actually go up as well. I don't know anyone that doesn't have co-insurance, co-pay, or deductibles on their health insurance. And I'm pretty sure some of those are going to be triggered should we not be able to work because we're needing to coincide with doctors, if not multiple doctors, to be able to get better. So we think about a lack of a paycheck, a lack of ability to pay normal bills, a lack of ability now to pay elevated bills, and really an ability for all of you folks as insurance professionals to be able to keep moving forward with that client, keep enforce the hard work and policies you put in place, as well as have a trajectory to further work with the client. So let's think about insulating our business as well with income protection because of the fact that without this, our clients are not protected, nor is our future work with the clients and past work we've done with the clients protected. So I urge you to think about disability insurance not only as an opportunity to protect your business and your clients, but really as a way to make sure that you're bringing the most holistic approach to your insurance protection with clients. I want to thank you for your time today. I hope you have a fantastic rest of your day. And please note that there's a lot of congruent ways to match disability insurance with the proprietary markets that you're in. Thank you very much, and you have a fantastic day.